Hi everyone and welcome to this video where we will be looking at some more adjusting entries. So let's take a look at this together and head on over to the computer. The geological consulting firm of Gilbert, Marsh, and Kester prepares adjusting entries on a monthly basis. Among the items requiring adjustment on December 31st, year 2 are the following. Okay, so we have two items here, and then we have three tasks that this problem gives us. So A, prepare the two adjusting entries required on December 31st to record the accrued interest expense and the accrued consulting revenue. Part B, assume that the $50,000 note payable plus all accrued interest are paid on June 30th. And then Part C, assume that on January 30th, year 3, we receive, or Gilbert, Marsh, and Kester receives $25,000 from Texas Oil Company. All right. So let's start with number 1 here. Okay, Part A for number 1. All right, the company has outstanding a $50,000 9% 2-year note payable issued on July 1st, year 1. What the heck does that mean? All right, that's a mouthful. All right, so this company, let's call them GMK, Gilbert, Marsh, and Kester. They borrowed $50,000 from the bank, and the term was 9% interest per year and 2 years until payment, or I'm sorry, 2 years until the loan needs to be repaid. All right. So the company has outstanding a $50,000 9% 2-year note payable. It was issued on July 1st. July 1st, year 1. July 1, year 1. Okay. Payment of the $50,000 note plus all of the accrued interest. So the interest is the charge for taking the loan. The bank, this is what the bank is charging GMK. So we're not making payments on the interest during the loan. We're paying it at the end of the loan when we repay the amount that we borrowed. So the $50,000 plus all the interest, it's all due June 30th, year 3. Okay, and then it says, what do we do at the end of December to accrue the interest? So we need to first figure out how much interest there was. And that's pretty straightforward. So to calculate interest payable, so the amount of interest that we have to pay, we're going to take the $50,000 loan, multiply that by 9%, and this is 9% per 12 months. And the reason I'm being so careful about the months here is because we took this loan, or GMK took this loan on July 1st, and we are preparing an adjusting entry as of December 31st. So July, August, September, October, November, December, 6 months have passed from the time the loan has been taken in July to when we are preparing our adjusting entry. So the interest expense is going to be equal to $50,000, which is the amount of the loan, multiplied by 9%. Now the 9% is, the interest rates are always stated in annual terms. So this is 9% per year. So we're going to divide this by 12 months and then multiply the whole thing by 6 months, because that's how many months have passed by the time that we've made, or by the time we're ready to make the adjusting entry. So let's do this calculation. Let's get our calculator here. So we're going to say, what was the amount? It was 50,000. 50,000 times 0.09 divided by 12 months multiplied by 6 months. So $2,250 is the amount of interest payable that we have as of December 31st. All right, so how do we record this adjusting entry then? So at December 31st, it'll say December 31st, year one, we are going to debit interest expense, which is in the income statement, and we will credit interest payable, which is a liability in the balance sheet. And the amount here will be $2,250. $2,250. All right, so that's our adjusting entry for number one here. All right, prepare the two adjusting entries, it says. All right, let's look at number two. Let's do the second adjusting entry. The firm is providing consulting services to Texas Oil Company. So GMK, the company we're doing the journal entries for, is doing a consulting engagement, or they're doing consulting work. They're giving advice to Texas Oil Company, and they're doing it at an agreed upon rate of $1,000 per day. So every day that GMK gives advice to Texas Oil Company owes $1,000 for each day. At December 31st, 10 days of unbilled consulting services have been provided. So at December 31st, we need to December 31st, year one, we gotta debit something and we have to credit something. Well, the credit is easy because we've earned it, right? The GMK has earned the revenue. They have made money by working 10 days on consulting for this Texas Oil Company. So this will be earned consulting revenue. And the amount will be $10,000. And I got this by saying, let's just abbreviate this so it fits on one line. On earned consulting revenue. All right. So we have earned consulting revenue, and the way I got this amount was I did 10 days consulting multiplied by $1,000 per consultant day. All right, and what did I say about the consult? They have not billed the client for this. So the client has not yet been billed for the 10 days of consulting revenue. Even though they haven't billed it, they are still owed that amount per the agreement with Texas Oil. So the debit here will be to accounts receivable. And accounts receivable is an asset account in the balance sheet. And this amount will be $10,000. So now we have our two adjusting entries for part A. These two entries here are the solution for part A. So I'll just highlight these. And then part B, it says assume that assume that the $50,000 note payable, the thing that we're talking about here in part A, assume that amount plus all the accrued interest is paid in full on June 30th, year 3. Okay. What portion of total interest expense associated with this note will be reported in the firm's year 3 income statement? Well, that's easy, and we've already calculated it. Year 3, the loan is going to be repaid on June 30th, year 3, which means year 3 will have 6 months of interest expense, and we've already calculated the value of 6 months of interest expense. So the correct answer here for B will be just simply, let me change the formatting on this. So this will be B is equal to this. It's 50,000 times 9% divided by 12 multiplied by 6 months, or $2,250. So this is the answer to part B. And then part C is asking us to assume that on January 30th, year 3, Gilbert, Marsh, and Kessler, GMK, receives $25,000 from Texas Oil in full payment for consulting services provided in December and January. All right. So the question is, what portion of this amount constitutes revenue earned in January? Well, how do we figure this out? Well, we know that the consulting revenue that we earned in December was equal to 10,000. And now they're saying at the end of January, the total amount of revenue earned is 25,000, and we've already recognized 10,000. So the amount that we can attribute to January alone must be 15,000. All right, so 15,000 is the answer to part C. So this one was pretty straightforward. Okay, well, thank you very much for watching. I hope you found this video helpful, and take care.